In 1850, Britain produced more than half of the world's iron, coal, and textiles. They built the railways that linked continents, the ships that ruled the oceans, the factories that powered global industry. British engineering was so advanced that other nations bought their machines, hired their engineers, and copied their methods just to compete. 100 years later, by 1950, Britain couldn't make steel at competitive prices. The textile mills were silent. The shipyards that once launched empires were rusting on the docks. The factories that employed millions stood empty. The nation that had invented the Industrial Revolution was importing the very goods it once supplied to the world. From producing half of everything mankind used to buy, to buying everything from the imitators it had once led, the workshop of the world became a hollowed-out economy, dependent on finance and services. Keynote: once you stop making, you start depending. They never recovered, not in 75 years, because once you lose manufacturing, you never truly get it back. Right now, in 2025, the United States is following the same timeline. We're a century and a half behind Britain, on the same downward slope: factory closures, shrinking market share, dependence on imports from the very rivals we once dominated. We're deep into stage 4 of a 5-stage pattern that ended Britain's industrial power forever. And Britain wasn't alone. In 1950, Detroit was the richest city in America, the automotive capital of the world. By 2013, Detroit was bankrupt. Before we trace the pattern, we need to understand what manufacturing really means for a nation's power, not in textbook economics. In practical reality, manufacturing isn't just making things. It's technological strength, supply chain resilience, national security, and the beating heart of the middle class. When you make things, you employ engineers who innovate. You train workers who master skills. You build networks of suppliers that create entire ecosystems of secondary industries. A single car plant doesn't just employ assemblers. It keeps steel mills running, parts makers busy, tool builders, logistics firms, engineers, and designers all thriving. Every factory job sustains 5 other jobs in the community. Keynote: manufacturing multiplies prosperity, services divide it. When manufacturing thrives, the middle class thrives. Factory jobs pay well. You don't need a degree. You don't start in debt. You learn by doing. You earn enough to buy a home, raise a family, build wealth. That was the American dream, forged not in offices, but on factory floors. But when manufacturing dies, everything built around it dies too. The jobs vanish, the skills erode, the supply chains drift overseas. And when those links are gone, rebuilding them takes decades. If it can be done at all. Once the factory's close, once the workers retire and the knowledge disappears, the capability fades faster than anyone expects. Every nation that's lost its manufacturing base has lost more than jobs. They've lost self-reliance. They've lost the ability to defend their own economic future, because manufacturing is power, and losing it is national suicide. So let's go back to where it began: Britain. The story of how the workshop of the world became an industrial graveyard. In 1850, Britain stood unmatched. The Industrial Revolution had begun there in the 1760s, and by mid-century they ruled global production. More than 50% of the world's iron, more than 50% of the world's coal, over 40% of all manufactured goods. British textiles clothed the world. British steel built the rails that spanned continents. British ships carried global trade. Their factories were the most advanced on Earth. This was stage 1, total manufacturing dominance. Britain held every advantage: the steam engine, the power loom, the Bessemer process, the railway, the telegraph, all British inventions. Coal and iron in abundance. A vast empire for markets. Capital to invest. Skilled workers who could build anything. They were so dominant they embraced free trade, because no one could touch them. Why build walls when you're winning every race? Keynote: dominance breeds complacency, complacency breeds decline, but dominance never lasts. Success breeds imitators. Stage 2 begins: competitors rise, copy your technology and improve it. By the mid-1800s, Germany and the United States began to industrialize. They studied British methods, imported British machines, hired British engineers, and then they innovated beyond them. Germany built technical universities and training schools far superior to Britain's apprenticeship system. Companies like Krupp and Siemens revolutionized steel and electrical engineering. By 1900, Germany was out-producing Britain in steel, and America was about to out-produce them both. The United States had its own natural advantages: vast resources, endless land, oil, a massive domestic market. Entrepreneurs like Carnegie, Rockefeller, and Ford built industrial empires powered by innovation and scale. By 1900, America produced more steel than Britain and Germany combined. This was stage 3. Market share begins to slip, competition intensifies. Britain's once unshakable dominance started to fracture, and by the time they noticed, the industrial crown had already shifted west across the Atlantic. Today, Britain imports nearly everything it once made: steel, textiles, machinery. Their last coal mines are gone. Their shipyards are museums. Their factories are office parks. Keynote: the first empire to stop building became the first to start borrowing. Once you lose manufacturing dominance, you don't recover. Technology moves on, competitors surpass you, and being first means nothing when others do it faster, better, and cheaper. But Britain's decline wasn't unique. Detroit would repeat the pattern a century later. Let's jump ahead to 1950. Detroit, Michigan, the Motor City, the crown jewel of American industry, the richest city in the nation per capita, the beating heart of the automotive world. Ford, General Motors, and Chrysler, the Big Three, all headquartered in Detroit. Between them, they employed 250,000 workers directly, and hundreds of thousands more in parts suppliers, toolmakers, steel mills, rubber plants, and logistics firms. This was stage 1 again: manufacturing dominance, a single industry superpower. If you lived in Detroit, chances are you worked for the auto industry, or for someone who did. The pay was incredible. Union jobs paid the modern equivalent of $25 to $30 an hour, with health insurance, pensions, job security. A high school graduate could buy a house, raise a family, and retire comfortably. If you lived in Detroit, chances are you worked for the auto industry, or for someone who did. The pay was incredible. Union jobs paid the modern equivalent of $25 to $30 an hour, with health insurance, pensions, job security. A high school graduate could buy a house, raise a family, and retire comfortably. Detroit's population hit 1.8 million in 1950, the highest per capita income in America. Highways expanded, suburbs flourished. Downtown glowed with theaters, restaurants, and luxury stores. The city was living proof that manufacturing built the middle class. Keynote: when you make things, you make prosperity. When you import things, you rent it. But success breeds complacency. Stage 2 returned. Competitors emerge, copy your model, and improve it. In the 1960s and 70s, Japan entered the US market with Toyota, Honda, and Nissan. At first, Americans laughed. Small, cheap, low-quality cars. But Japan didn't stay small for long. They studied American manufacturing and made it better. They created lean production, just-in-time inventory, Kaizen, continuous improvement. Their cars became more reliable, more fuel-efficient, more affordable to maintain. When the oil crisis of 1973 hit and gas prices spiked, Americans abandoned their heavy, gas-guzzling cars for Japanese efficiency. The Big Three refused to adapt. They kept making the same large, unreliable cars, assuming patriotism would protect them. But consumers voted with their wallets. Keynote: arrogance is the luxury of dominance, and the death of it. Stage 3 began: market share collapse and offshoring. By the 1980s, Japanese automakers controlled 30% of the US market. The Big Three panicked, cutting costs instead of innovating. Factories closed. Production moved to cheaper regions: Tennessee, Mexico, anywhere wages were lower. Detroit's auto employment fell from 250,000 in 1950 to 100,000 by 1990. And the decline didn't stop. Stage 4 arrived. Factory closures accelerating, jobs vanishing, neighborhoods hollowing out. The 2008 financial crisis was the knockout blow. GM and Chrysler went bankrupt. Ford barely survived. The government bailed them out, but Detroit's factories never reopened. The Motor City, once the symbol of American manufacturing might, became the graveyard of it. Vacant skyscrapers, silent plants, crumbling neighborhoods. The city that once built the world's cars could no longer build its own future. When the machines stop, the cities die, and when the skills vanish, the nation follows. Detroit's story isn't just about cars. It's about what happens when innovation is replaced by imitation, when cost-cutting replaces craftsmanship, when short-term profit replaces long-term strength. The fall of Detroit wasn't an isolated tragedy. It was the opening act of the Rust Belt collapse. The same pattern spread like a virus across the American heartland. Cleveland, Pittsburgh, Buffalo, Youngstown, Gary, Akron, cities that once made the world's steel, glass, tires, and engines began to rust. In the 1950s, the Midwest powered America. Every factory town had its rhythm. Whistles at dawn, smoke at noon, lights blazing through the night. But by the 1980s, the hum of machines gave way to silence. The factories that forged a superpower were shutting down one by one. The reasons were always the same: cheaper imports, automation outsourcing, environmental regulation, and corporate greed disguised as efficiency. Politicians called it globalization. Economists called it progress. But for millions of Americans, it meant unemployment, addiction, and despair. Keynote: every chart of progress hides the pain of those left behind. Youngstown, Ohio, once home to the largest steel mills in the world. On September 19, 1977, 5,000 steelworkers were told their mill was closing. That day, families gathered outside the gates in disbelief, some crying, some screaming, as the blast furnaces went dark. Overnight, 50,000 people lost their livelihoods. The town never recovered. In Buffalo, Bethlehem Steel closed in 1983. In Pittsburgh, the steel industry that once made the city glow red at night collapsed under foreign competition. Unemployment soared. Businesses shut down. Property values evaporated. Factories that had run for generations were stripped for scrap. Streets turned quiet. Houses decayed. Entire neighborhoods disappeared. The children of steelworkers and machinists grew up in a world where their parents' jobs, and the pride that came with them, no longer existed. America entered stage 4. Financialization. When you can't make things, you start moving money instead. Wall Street became the new factory floor, and debt became the new export. Keynote: when production dies, speculation becomes the illusion of growth. The 1980s marked the shift. Manufacturing share of U.S. GDP fell from 25% in 1960 to under 12% by 2010. Finance, insurance, and real estate ballooned to nearly half the economy. America stopped producing goods and started producing credit, mortgages, derivatives, loans, and paper wealth that could vanish overnight. The nation that once built the world's engines now built bubbles. And when those bubbles burst, in 2000, in 2008, and again in 2020, the working class paid the price. Factories didn't come back. Jobs didn't return. Wages stagnated while asset prices soared. This is what Britain had done a century earlier, shifting from manufacturing to finance, from building things to trading them, from real wealth to abstract wealth. An empire of debt always believes it can borrow what it can no longer build. By 2020, the average American city that once made something tangible, steel, glass, tools, engines, or textiles, had been replaced by logistics warehouses, call centers, and dollar stores. The physical economy was hollowed out, replaced by services that shuffled products made somewhere else. The new economy didn't build pride or stability. It built dependency. A handful of tech firms replaced thousands of factories. A few billionaires replaced millions of middle-class families. The national balance shifted, from makers to managers, from builders to bankers, from citizens to consumers. And still, the illusion of prosperity continued. The stock market soared. GDP grew. Politicians pointed to numbers, not neighborhoods. They called it progress because charts went up. Even as towns fell apart. Keynote: a rising graph can hide a dying nation. The United States today stands exactly where Britain stood in 1950. Factories gone, debts rising, wealth concentrated, workers struggling to stay afloat. The empire hasn't fallen yet, but the pattern is already written. Stage 5 is coming. The final act of every industrial power. When the world stops believing in its currency, its production collapses, and its people realize that prosperity was borrowed, not earned. The decline of currency and credibility is the stage every empire reaches when production has vanished, debt has peaked, and the illusion of power depends on paper and promises. Britain reached it after World War II. The pound collapsed, colonies broke away, and the empire that once ruled the seas was reduced to a small island with big memories. The same symptoms are appearing in America today. Trillions in national debt, interest payments larger than defense spending, industries offshored, infrastructure decaying, real wages stagnant for half a century, yet the markets still rise. Because the money itself is no longer tied to production, but to faith. The world still believes in the dollar. for now. But every empire thinks its currency is different, that it can print without consequence, that it can live on consumption while others do the work. Confidence is the final resource of a dying empire. Once that confidence breaks, everything that looked strong becomes fragile. The currency weakens, inflation bites, foreign nations de-dollarize, and the financial empire begins to crack under its own weight. History doesn't repeat, but it rhymes. And the rhythm is always the same: build, dominate, decay, and deny. Factories don't return because the skills are gone. The workers who knew how to make things have retired or died. The apprenticeships disappeared decades ago. Supply chains are foreign, machinery is imported, and even the materials to rebuild are sourced from the very nations rising to replace us. When an empire outsources its production, it outsources its power. And when it forgets how to make things, it forgets how it became great. Britain learned that lesson too late. So did Rome, so did Spain, so did every nation that believed wealth could come from paper instead of production. The empire that stops building begins begging, first for goods, then for mercy. America isn't doomed yet. But the warning signs are everywhere, not in the headlines, but in the hollow factories, the shuttered small towns, the debt statistics no one wants to read. The same pattern that took Britain a century is taking America barely 75 years. The gears of decline spin faster now. And when the history books are written, they'll ask the same question they asked of every fallen empire. Before, how could a nation that built everything end up producing nothing? The answer will be the same. They traded strength for comfort, creation for consumption, and production for promises. Because every empire dies the moment it believes it can buy what it once had to build. The fall doesn't begin when the factories close. It begins when no one remembers how to reopen them.